Well, stocks ended mostly lower yesterday as investors await the outcome of today's Federal Reserve meeting. But the economy, well, it's been on a tear, and consumer confidence hitting an 18-year high this month. What does it all mean? Let's ask David Nicholas, president of Nicholas Wealth Management. David, good to see you. Thanks for coming on. Let's start right there with consumer confidence, my friend, because you have to go back to the dot-com bust to find consumer confidence that's been higher. So right before the bust, consumers on a tear. Are we headed for another downturn, or possibly in the markets, or maybe even the economy?
Yeah, GDP last quarter, 4.2%, right? Consumer confidence, 18-year highs, unemployment, 18-year lows. So, Gerri, this is unique to the U.S. economy. The rest of the world is not experiencing this. So I think this economy still has legs in it. No concerns for the rest of the year. But as we get into the later stages of 2019, I think is where investors need to remain cautious, to just see really how much more legs does the U.S. economy have. So I think we'll start to see some type of slowdown fourth quarter of next year. But until then, everything looks great.
Well, everything looks great. Nothing hurts. And, of course, I think consumers really responding to the jobs numbers and what they're seeing in the market for their services. That's what's propelling their confidence right now. But you've got to ask yourself, is the Fed getting behind the curve on inflation? That's typically what they do. They get behind and then they start tamping down too late. Could that be the case this time around?
The Fed chairman has made it clear that he doesn't want to get too far ahead and let the economy overheat, but they're trying to get to neutral, which is a period where, inflation isn't stimulative to the economy, but it's also not hurting the economy. But, Gerri, I think what you're getting at is we really don't have a case study in seeing this unwinding work before in history. So, I want to remain positive, but, there's very little data that supports really what we should suspect as this tightening schedule increases. So we're still positive on the U.S. economy, but investors just need to remain vigilant. We're longest bull market we've had in history. So we're getting close to the end, in my opinion.
Getting close to the end. Well, I hope you're wrong on that. And meanwhile, we're expecting a quarter-point rate hike today. That seems to be baked in the cake, possibly another hike in December. We're looking forward to 2019. But one thing that people are looking for in today's FOMC statement, I want to read you what is normally in the statement. The stance of monetary policy remains accommodative, thereby supporting strong labor market conditions and a sustained return to 2% inflation. Boy, that sounds dated. Could that go out today?
Yeah, I think the key word there is accommodative. I think investors are going to be looking for that word. If that word is removed, it'll be very telling. But again, the chairman wants to get to that neutral part of the economy. But I think this is still a bullish signal that the Feds believe that the economy is strong enough to support a rise in interest rates. So, I'm remaining confident, but I don't think we're going to see a major concern in the markets. I think the market has priced in an upward move with rates.
Well, we're showing the markets this year all in the green. And for September, the Dow was up more than 2%. Very good news for investors. Hope it continues. David, thanks for coming on.
Absolutely. Thanks for having me.